Cool, we'll get started. Good evening, guys. Thank you for joining in. This is like the second edition for the Market Action Pulse. I'm Karan. Calling this edition here is basically Deja Vu Ka. Just a wordplay on Deja Vu. And if you missed the last time around, VUCA basically is the world that we are in. VUCA stands for volatility, uncertainty, complexity, ambiguity. That's the kind of world that we are in. A world that is desynchronized, but not directionalist. Happened then since the last time that we met. It looks like a long time back because that is how fast and how much that is happening in the world. You have tweets coming out, you have wars breaking out. Just every other day there is something or the other, which drives the market in a certain direction. And this is the kind of the beauty that we are in. It is a volatile world. It is a world that is uncertain. It is a world that is complex and very ambiguous. When we met last time around, we discussed that India is it's kind of facing some bit of fatigue at a very high level. We went in too hot, like in the turn one of a lap 5, and that's what we saw over the last month or so. India the markets are down around 2.9%. Over the 3 months, again, we are the ones that are lagging the entire rest of the world when we compare ourselves with US and China. We are also lagging in the 6 months. However, when you look from a longer term perspective, over the last 5 years, India has given quite a good return. So what happened over the last month? If I were to, I guess a lot of people have seen the Formula 1 movie that has come out. And if we are to talk in that parlance, India went too hot in turn 1 on lap 5, and US probably has drained all its battery just to move too fast. While China has just switched to soft tires is what we feel. So bringing it back into a financial thing, we think that possibly the lower performance that you see in China over the last 2 years, 5 years per se, with the kind of valuations that they have, it looks like they just took a pit stop and probably have switched to a very softer tire or a very faster tire as such. India, while obviously when we were at a very, very high level, we were fatiguing out. So we had to hit those brakes. So that's what you see over the last 1, 3, 6 months. And US basically is just moving at breakneck speed, at least in terms of the market. Although fundamentally, we might just be kind of a little, a little behind, in terms of, we think the markets are front running the fundamentals, and as we'll see going forward. This is what I was talking about. This is like the entire global macro circuit as such. If you look at US, you see that after a slowdown in the first quarter, you saw the GDP go into negative, minus 0.5. The first estimates of the quarter 2 have come out to be 3%. This is what we discussed last time around as well, that based on the data that we were receiving back then, a recession looked unlikely. However, the growth consensus that had come out was around 2.4 to 2.5%, while US gave a growth of 3%. The problem for US here is not the PMI, not the GDP growth, but the third column here, which is inflation. Inflation, which was on a downward trajectory, it was looking like that sticky inflation, which has stayed there since 2021 after years of no inflation at all because of revenge consumption. The inflation that had gone up, that has stayed for quite a bit of time, and in a trajectory wise, it was trying to come down. Now, for the first time, you see that inflation is coming back again. What this means is that it puts a lot of pressure on central banks across the world, and that's so that like central bank in terms of Fed, it puts a lot of pressure on them. When you move to UK, we feel UK is beginning to see a reflationary kind of a thing. Reflation is basically, after a very slow growth, you're just trying to get again through the, just through the corners and trying to bring back the economy. That's the kind of state that UK is in. So when you look at the GDP growth, it's hardly barely there. It was around 0% across time. It was negative at one point of time. We're just barely getting there, but inflation is quite high out there. So again, it could possibly lead to kind of a stagflationary scenario. But at this point of time, again, based on the data that we are seeing, it looks a little bit of reflation coming out there. China is the one that was seeing a lot of issues in terms of shadow banking, in terms of property bubbles. They were supposed to come out with a large big bang stimulus last year, somewhere around September, October, which never happened. However, what the policy has been of China, what they have done is that they have tried to bring in slow kind of, stimulus into the picture. And that is where you see, GDP not going away, like not falling off the thing. You had a deflation scenario last time that we met. It's again moved back into positive. This is quite positive in a way. And with the early indicators of PMI, it looks like China is starting to grow back again. When you look at Japan was a very, very, it's probably the one of the most, for lack of a better word, weird places to be right now. We'll speak a lot on Japan when we meet next time around, because, you would see Japan taking a major, bigger picture in what. Yeah, so you would see Japan taking a bigger picture in how the world plays out. What's happening in Japan is basically, after years of controlling the yield curve, they finally let go of yield curve control last time around, like last year around, and try to increase interest rates and try to bring inflation under control. While inflation is starting to come under control, GDP has taken a bit of, the after effect of, increasing interest rates. GDP is what is not coming through. So while the engine's running, you're trying to slow it down while not having growth. It's a very different scenario to be. Again, Japan as an economy needs an entire different discussion, and that's what we plan to do it next time around. For now, we feel that they are kind of, we feel that they'll sail through at least for a couple of weeks to a month or so. And PMI for them is kind of being stable at this point of time. If you look at Eurozone is seeing, okay, inflation's there, kind of again barely moving forward with GDP growth, and growth sentiments are just stuck somewhere in neutral. So Eurozone is also finding it a little bit difficult, and that leaves us with India. It is one of the possibly one of the better placed situations out there, better placed economies out there. PMI is rock solid at 60. We're slightly down from last time around that we met. It was 61. Now we're at 60.7. However, 60 is a very good number to be. Any number beyond 50 is basically an expansionary scenario. We are at 60, which is like that's where we were coming from. That it's getting too high altitude to be there, and it is fine. The markets have taken a breather in a way, and that's a good place to be. Our GDP growth continues to go on, and inflation is very much under control. So with this, we've also front-run our rate cuts as well. We've seen two big rate cuts happen, and that is where we feel that India is still kind of leading the lap. So in short, what we feel is that US is accelerating on the trade map. India is still leading the lap. China is a very tactical call here. China is something that, again, could, as I said in the previous slide, that it looks like they have taken a pit stop and have moved to very faster tires. Europe is coasting around, trying to figure out what to do. Japan is something which we'll talk in detail. We'll continue. You guys, all of us will start getting a lot of details on Japan as yields out there try to break through. Not a good scenario to be, but we'll come back to that. And India probably again as leading the race. Moving to just specific Indian scenarios. So just moving to the Indian scenario, your GDP again is going, if we compare where we were in 2024, the same quarter, we're much better off. We're growing quite fast enough. The composite PMI has stayed through. It's stayed at 60 level, which is a really good place to be. Inflation has been controlled. We were at around 5%. 5% for, if you look at the RBI targets, the broad band of 2 to 6, around 4ish. We are at the lower band of that. Really good place to be. Unemployment rate, which was last year at around 8%, has come down to 5%. However, we are hearing a lot of things about big tech companies starting to lay off people, and hence you see the unemployment rate start to go up again. Not a good place to be. So if you and the only problem here across all of this is that sentiments in business are probably at a low. A lot of reasons drive that, because we've grown so fast, because there was an overhang of tariff, because again the world itself had an overhang of tariff. Plus you have different geopolitical tensions going around across the world. So again, in a nutshell, you've got a good GDP, inflation under control, higher composite PMI, unemployment starting to weaken. Till there is you still at 5.6. You're not as bad as you were last year, but with the news coming in, with new data coming in, it looks like this is one that would start creating a bit of trouble. Sentiments are low, but now with the overhang out, possibly these can set all of that. Having like the last possibly 7 months have been a roller coaster ride for everyone out there. You started out with in January you started out with tariff talks. February you moved to the meeting of Trump with Zelensky. March you had a geopolitical tension. April you had tariffs, and it continued on and on. And this has been kind of that year where something or the other comes up. Overall, in a nutshell, it's not been a year which is very different than a median year. So when you actually look back in hindsight, you just like a normal medium year. What we've done is we've taken data since 2000, ran all the iterations till 2025, and looked at how a median year turns out to be generally, and we are not far off. As of July end, yesterday, we are exactly the return a median year should have given. Now, understand the fact that this is a median return when your economy has been going very fast. So that means that markets have taken a lot of volatile hit. It's just that because India was going so fast, you've been able to achieve that median returns as such. The real idea when we started out, this is something from 2025 January that we said we expected the year not to be much different than a median year. It's turning out to be like that. It's just that the lows are lower and the highs are higher. So that means that we kind of in a very volatile situation. When you just rotate around the median, it becomes the ups and downs kind of create the anxiety and the panic which happens in a market. So that's where that's the one that one has to kind of take care of when you are actually moving around the median year. A lot of things happened post April and post the geopolitical tension between India and Pakistan. We had a geopolitical tension in the Middle East. Now that is where a lot of issues again drive through. You've got in the Eastern European geopolitical tension. You now have Trump putting like a 10-day period for Russia to come to the table and negotiate a ceasefire. All of that leads to oil being very volatile. What we figured out here was that even if you take out a bit of the geopolitical tensions, we are moving to a world which is more greener in nature, which is more sustainable. There are certain accords that one country has to meet. Obviously, if the countries meet it or not is another whole different story to discuss about. But we are actually trying to move towards a more sustainable future. And when we are trying to move to a more sustainable future, these are the kind of paths that you can take. Now, in a world which would have been in a low geopolitical tension, and if the renewable adoption was very high, if people were moving to renewable and adopting renewable energy just like that, and there were no geopolitical tensions, then you would have had a gradual renewable integration. You would have easily seen people move to solar. You would have easily seen people move to wind, thermal, other nuclear kind of energies. And in a world which was low on geopolitical tension and where the renewable adoption was lower, the traditional, the one that is continuing, like oil, which is continuing as the main source of energy, that would have continued to be in dominance. But we're not in this part, and we're not in the left-hand side of this particular chart as such. We are on the right-hand side. Now, in this right-hand side, where you have high geopolitical tension, and if you had high renewable adoption, and had seen possibly everyone move to electric vehicles, had solar panels on their roofs, then you would have had an accelerated energy transition. Like this is what would have happened. Everyone would have moved to possibly a green energy kind of way of living. But we don't see that right now. So hence the adoption for renewable is quite low at this point of time, and the geopolitical tensions are high. When you are at this scenario, what you have to do is basically you have to have a price-driven shift. Now, what does the price-driven shift mean? Is that again, as this presentation is called Deja Vuka. Why is it called Deja Vuka? Is because we've come to this scenario before, right? We've come to this scenario back in the late 1960s and the early 1970s, where the major predominant source of energy was basically coal. At that point of time, oil replaced coal to become the major source of energy. Now you are here, where again in a world which is mostly a very high geopolitical tension area, you have green energy trying to substitute oil. So when the last time that happened, coal became very expensive and forcing people to kind of start using oil, right? So that is how people transitioned from coal to oil. Now, if that playbook has to repeat again, oil has to become so expensive that today, if someone were to buy an electric vehicle, what a person would do would open up an Excel, try to figure out that what is my cost of an electric vehicle, what is my cost of a petrol vehicle, try to do different math. They would then take an assumption that petrol for me would stay at around 100 rupees a liter. This is the amount of kilometers I drive in a year. And after all that math, at this point of time, a lot of people still avoid using an EV, right? Here, the biggest issue with this particular Excel is that you're assuming that oil or petrol remains at 100 rupees a liter. If the petrol prices were to increase manifold, or increase like 50 to 60 to 70%, the whole of the math is not required. The minute you reach a petrol pump, it will start pinching you, and your mindset will start asking you to move to an electric vehicle. And that is how, in a high geopolitical tension and a low renewable adoption era, that is how people move from the traditional source of energy to the new source of energy. And that is what we are seeing here. And possibly that is the reason why we feel that, oil could again see kind of levels that were last seen possibly around 3 years back, and try to come to those levels. Again, obviously, the 3 years back, we did not feel the pinch of oil prices because the government in India absorbs a lot of that price rise. So that's there. We will have to see how the government reacts if this particular playbook were to play out this time around, and how differently that happens. So eventually, the bottom line is that ideals don't change your habits. It is the pain at the pump. Basically, the pain in your pocket is what changes your ideals. If you are finding it difficult to, pay for that, it hurts you to pay for that petrol car, you would easily switch to an electric vehicle. So that is where we think we are. Moving forward, what we feel could be the triggers for a US equity correction, because again, that as we started out in slide 1, we feel that the battery is draining out from US. It's moving at quite a high speed, and possibly using a lot of its own battery power to do it. It's not using fuel, it's using its battery power. Again, in Formula 1, if you kind of use battery power a lot, you move very fast, but then you use up a lot of energy to move, overtake other cars when the opportunity arises. And this is the reason, we feel is that the AI boom looks like brilliant on the surface, but there is some bit of froth coming in. So if you look at this is from the Queen. This is late stage venture capital AI valuations. If you look at how the valuations have gone across the last 5 years, you'll see a lot of high valuations at this point of time, and you see that 50% of the deals that are made, at least in the VC space, are done because of an AI. If just because the startup says that they are using AI. So AI is half of all the new unicorns. Nearly 50% of the recent unicorns are AI focused. And here what we feel is that valuations are front running fundamentals. So there is a lot of like missing out. People who missed out on deals on OpenAI kind of investments are running after kind of those deals are happening at this point of time. And this is not for the first time that this is happening. This has happened, like, again, this is another deja vu cycle which happens. This has happened back in 2000, which was the dot-com time. This happened in the crypto space as well in 2017-18. This happened in your acquisition vehicles which were created, the SPACs of 2021. Now it is a new technology. And while AI has some real tech behind it, the valuations are front running the fundamentals is what we feel. And a lot of this is basically because of FOMO-driven capital. A lot of this is also mislabeling, which is very rampant out there. Firms that use some bit of algorithms end up calling themselves as artificial intelligence, while it's more algo-based kind of a thing. And here the due diligence matters a lot in terms of the real investors end up asking that how do we end up monetizing this AI technology? Who owns the data? And is the tech like defensible against certain parameters out there? So eventually narratives don't kind of return capital. It is when actually the dust settles. There is a very interesting case study out there based on Microsoft, which says that, yeah, so there's a very interesting case study in Microsoft, and let me see if I can pull this out for you. Just give me a second. So if you look at Microsoft, and you look at the prices that it achieved in kind of 2000, the dot-com. This is the dot-com. Microsoft itself, back in 2000, if you picture yourself back in 2000, there was no Apple OS as such out there. If you had a system, it had to had either a DOS or a Linux system out there, right? And most of them were DOS systems or a Windows XP system out there. So without an operating system, it looked very difficult to run a computer, right? But look at what the prices did in 2000. Microsoft on a split adjusted basis was around $51-52 a share. It entirely took Microsoft around 16 years to reach back to these levels, right? So this is how valuations front run fundamentals. It took quite a bit of time for valuations to kind of come back to what it was during a bubble phase. So this is a very interesting case one can read into and look at, and that's what we feel could possibly trigger a US equity correction. Moving on, it's not just the valuations. There have been certain policy mistakes that have already been made by the US. There've been many, but if we were to look at some key mistakes that have happened in the last 5 years, the first one was basically back in when the pandemic hit. I think US gave out a lot of helicopter money. They actually, in terms of, if you look at Indian thing, they did it in 3 rounds of what cash was put into people's account. And in Indian terms, it turned out to be around 1.5 lakh rupees into your bank account. That's like an emergency fund for a normal person. You almost a 3 to 6 months kind of a salary kind of thing, which is generally called an emergency fund, that was put into everyone's kind of account back in 2020. At that time, Donald Trump was the president. And if you look back at that particular point of time, it was more the government taking such kind of decisions rather than the central bank stepping in. Even in India, when we saw the finance ministry, what we got was basically subsidized loans. We were given a moratorium period on our loans, that it's fine that you don't pay interest for some bit of time. But we would never put money into our account, which at that point of time, a lot of people were angry around it. It was disappointing. But when you look back 5 years, like when you run 5 years now, India's got quite a healthy, much more healthier, balance sheet compared to US. The second mistake that was made was in 2021, and this was when the revenge consumption came into picture. That Trump thought that inflation is transitory. This is something that we've been very vocal about. Inflation, US had not seen inflation for almost like 3 generations had not seen inflation, and suddenly inflation propped up into the system. This is entirely on Powell. Possibly rate hikes should have been a little faster. They waited for some bit of time thinking inflation was transitory, and when it got sticky, that is when Fed started that draconian move of raising interest rates up to 5%, like the largest swing that we've seen across like the last 20 years. And the third was basically what we call is the treasury cocktail that was given, the liquidity cocktail that was pushed out in 2023. The economy was kind of the employment data were getting shaky. GDP was a little bit slowing down, and to avoid a recession, I think the treasury printed a lot of money out in terms of trying to avoid a recession. So basically what they did was basically avoid a recession back in 2023, but then in 2024 and 2025, now you have the inflation hangover, which is there. So where does that leave US today? It leaves them with growth, which is slowing down. You've already had 1 quarter of negative GDP. Thankfully, we've been able to bounce back. Inflation is just being sticky around 2.7% right now. 2% is the Fed's target. You've not got into that 2% level ever again. You moved from you went down to 2.4%. Now you're back to 2.7%, and that's like inflation. Once it starts kind of pushing out, once it starts increasing again, it's very difficult to get it back into control. All of that, the pressure was shown on dollar. We spoke about dollar last time around as well. Since then, dollar's kind of lost around another 10%, and then there are no buyers for US debt. So the buyers for US debts are shrinking. So basically, and across all of this, across the last month, the only conversation that we heard around all of this was that should Powell be fired or not? That's like the most wrong question to ask out there, because when you've got a problem, you don't find a scapegoat. You actually fix it through reforms. You restrain yourself. It's a very common problem. The income of US is way lesser than the expenditure of US, and a big beautiful bill does not kind of solve that problem. So eventually you are still again back at that same problem, and I think that question thankfully wasn't taken, like it didn't go through. But you don't end up finding a scapegoat when the problem itself is not being resolved. That leaves Fed with a very tight rope to walk. There's sticky inflation out there. Price pressures are persistent out there. Growth is slowing down, and labor market is being wobbly around it. So what should Fed do? I think Jerome Powell, despite all the pressure out there, is doing kind of what a central bank should do. They should naturally let the yield curve steepen out. Let the short term anchor your inflation, and then let long term rates reflect the market risk out there. So that's when your yield curve starts steepening out. A very high or very steep yield curve becomes a problem, but a general nice trending yield curve is something that can possibly bring back the economy into shape. You have to give targeted support. There are certain areas out there which need support. Pharmaceutical, healthcare, kind of that. You give them targeted support, but you don't open up a QE floodgate if the growth were to slow down, or your labor market start deteriorating again. Again, what Powell is trying to do is he's trying to stay high for longer and being nimble around it. Every meeting that we've heard him, he's been very data dependent, trying to walk a very tight, a tight rope kind of a thing. And while the market was pricing until now a kind of a rate cut, basically this kind of playbook is something that we don't agree to. But this is what the market was trying to do, was figuring out whether if possibly under pressure the Fed could cut a rate, just given support to the labor market and trying to prop back growth again. That did not happen in this meeting, but that's a kind of a very wild card move. Why is it that a wild card move? Is because then you start playing with inflation again. And inflation remain not under control, and then if you try a rate cut out there, that's a very weird place to be. If once it gets untamed, or it's still not tamed, but once it gets wild, inflation can do a lot of damage. So obviously, this is not a soft landing that we were expecting for. Obviously not. This is not kind of a hard landing as well till now. What we told last year was basically we feel that this is kind of a no landing space right now. In the last meeting, we thought that this is kind of a stagflation light. We're still there. We don't think that we'll hit a hard stagflation just yet, or possibly next year. We'll continue to be data dependent. We'll continue to see what other policies come out. But this is a very, a very difficult place for a central bank to be, and that's what Fed is up against. And all of this the dollar has kind of taken the hit on it. So you've seen 2025 be the worst year for dollar since date. So this is between 2000 and 2025, 25 years of data. The light blue line out there is basically the year of 2024. The dark blue line is 2025. You see the returns being quite negative out there. And dollar is having its worst year. What happened across the year? Again, in January, you said you had Trump signal out that I'll bring in tariffs. Feb, you had that White House meeting with Zelensky. The trust was broken out there in terms of whether you are an ally, you are not an ally. April, you brought out the tariffs on a blackboard. And then eventually, again, that negotiation deal, it was earlier supposed to be 1 month, then became 90 days, then became a 1 month extension. One thing that the market does not like is uncertainty, and the dollar's been bear the brunt of it. It's still not collapsed. It's still out there. It's trying to recover at this point of time as we speak. But it's just something that people have stopped trusting as of now. So once I think people stop trusting the currency, you have to bring out certain other parameters to actually start doing that. So that is one bill that was passed last month. It was called the Genius Act. Let's see how genius that act is really. So basically, with dollar doubts coming in, growing into the economy, what the Genius Act does is basically it pegs, it brings out stable coins which are pegged to the short-term U.S. government bonds. Now, understand here that nobody wants U.S. government bonds at this point of time. If they were wanting it, the yield shouldn't have been where they were or where they are right now. Now, what you've done is you bought out certain stable coins, which will be, which could take possibly the action or become the currency as such. Maybe we don't know yet, but they are pegged to the U.S. government bond, the short-term U.S. government bond. What this does is basically it moves away power from the central bank to the treasury. So now the fiscal policy takes the driver's seat apart, rather than the monetary policy being the main driver of an economy. Again, this is what happened in the pandemic. Where fiscal policies were kind of were the ones that were driving the next set of moves. We possibly moving there again. It's not just a payment shift; it's like a power shift. You're alternating, you're moving away basically the central bank. You're weakening the central bank's authority on how they manage the economy as such. And eventually, one has to realize that if nobody wants US, yet the market is quite hungry about this act, but eventually they'll catch up that if nobody wants US bonds, it being in a different package does not change what is underlying it, right? So changing the label won't fix the product. If one has to understand that the debt of US is too high at this point of time, and already when the world's questioning what's under the hood, this could be just the first act of a post-dollar kind of a play. So possibly that is it. On this, you see the hypothetical yield curve that has been drawn. What a stablecoin hypothetical yield curve looks like, and when adjusted to your lending rates, the green line is where your hypothetical yield curve should be. Currently, as we saw on the last slide, the yield is around 4.25, 4.3%. hypothetically, the green line says that we should be around 5.5 or 5.6%. So how are we placed at this point of time? This is again coming back from last time around. We're still neutral on India. Definitely much more, much more weightage given to large caps. We still underweight US. We still underweight Europe. China is where we made the change. We've gone from slight underweight to neutral position. And Japan again, we'll talk in detail in Japan in the next meeting. We still underweight here. All of this, what we are kind of looking at this point of time, our data points are basically how the inflation comes out to be. What is happening in the Middle East gives a lot of clues as to where we are headed to. Tariffs, some bit unresolved, some resolved. We'll come to that in a different slide later on. But again, that is a certain talk that we are looking at. This is our global equity view. Neutral on India, underweight on US, underweight on Europe, move to neutral to China, and underweight on Japan. In terms of sectors, we quite underweight IT. We are underweight on auto. We neutral on private banks, and while the others we kind of are slightly overweight. We quite okay looking at metals, public banks, a bit of pharma again because the tariff news. How does it affect pharma? But it's being a defensive sector. This is where we think a lot of good like domestic plays are available. Autos we selectively underweight. Domestic plays of autos we kind of like, but those which are focused on exports, there we like to be underweight. And consumer staples is another one which is quite a defensive sector and does well when in a volatile world. So basically, there is no blind oversight on certain sectors. IT remains an underweight, and autos selectively underweight. We like domestic themes out there. In terms of debt, we quite neutral on debt. We've had a decent rundown in terms of yields. At this point of time, we don't want to chase yields as such. No need to stretch for yields. We happy preserving capital for any opportunity that comes around, either in equity or in commodities, precious metals, or in debt. We're happy holding a little bit more cash than usual, but we're not chasing yield as such because we think that the yield has come down quite a bit. So this is how we are positioned today. Depend on what kind of a risk profile that you as a investor are. If you're conservative, we'll like to hold a bit more cash than if you are aggressive, and if you're aggressive, a bit more in equities. However, we continue to hold quite a large amount of cash, holding it steady for any. We feel that optionality is quite underrated at this point of time. This dry powder in cash gives us a tactical advantage to take a certain bit of, again, news that comes out. Things like, tariff on copper one day, no tariff on copper the other day. So things like that, if come out, they give us much more easy access to markets than being committed to one particular kind of an asset class. We are holding equity steady. We letting commodities lead the charge, and then we're trimming debt with care and keeping some bit of dry powder out. This is our January 2025 outlook. This is our the annual outlook that we came out in January, showing how we would like to place ourselves across the entire year. These were the sectors that we kind of ended up liking. We loved PSU banks, that has kind of delivered. We loved infrastructure, again, something which is metals we've been very vocal about, and energy is something that we are very vocal about. And we've been largely underweight IT, and thankfully that has not performed. So the sectors that we backed early on have turned out to be very strong performers, and the sectors that we didn't back have underperformed, and that worked in our favor. The question that some of the ones that we got, this was the bigger one. A lot of questions around this. So let's talk about it. Like there's no way around this. On this day, on August the 1st, when tariffs actually come into picture, they're no longer a threat. It's now a reality. So let's face it. We've been hit by around 25% tariffs plus some penalty on if we take Russian oil, crude oil. And you saw the reaction in the market yesterday as well. It was briefly kind of turned risk off, but one thing that the market does not like is uncertainty. Now there is certainty. Now you have that 25%. Obviously, there's no deal on it. We're still negotiating. I don't know. The deal will be much lower than this, hopefully. It depends. Again, something that we can't be very sure of, given the world that we are in. But 25% is like a baseline number, good ballpark number to begin with. The market didn't know this. They had this 26%, but given that it was taking so much time, they were trying to figure out. You saw the reaction yesterday, and then it stabilized again. So that's what's happened. This is out now, and there's no overhang of it anymore, which is nice. The sectorial impacts that we feel can happen, it will impact the textile and gems sector. There's a high dependency on US of both of these sectors. However, for the textile sector, one thing that is working in India's favor at this point of time is that two major producers of textile, Cambodia and Thailand, are diplomatically strained, and this gives some short-term edge at least to Indian exporters. Automobiles, as I said, we liking domestic players. They're quite insulated in certain sense. Export-oriented firms may see some bit of downside. Oil and gas, this is again depends on what kind of penalty we get for using Russian oil. What we feel is how, if you've been following us, if you've been following our insights, you would know that we're quite bullish on oil drillers. And that's where how we think that, we have to look inside till the time that we kind of move to a green energy future. We'll have to look inwards for an alternative strategic resource. Pharma is something that hasn't got kind of pure play at this point of time. As such, it might face some bit of margin headwinds and regulatory friction. Again, let's see how that works out. Pharma being a very defensive play in terms helps us at least in this volatile world. So that's a very different way to put at it. So tariffs no longer are a policy like a tool anymore. It is a reality. It's the reality of the world that we live in. And what is the world that we kind of live in? We live in kind of a new kind of a Cold War. This is another question that we got around geopolitical tensions that are there. So again, this is nothing new. This is different centuries, same tensions, but just the front lines are very new. So globalization, we feel, is being fragmented. There is no denying the fact. There are a lot of nationalist policies coming out. A few countries trying to protect their own strategic reserves, strategic metal reserves. There is a lot of protectionism going out. There's a lot of self-reliance that is there. Strategic sectors, you would absolutely see, that protectionism and self-reliance come into the picture. And that just leads to geopolitical tensions. You have, decaying alliances, existing alliance decay. Swing states then become very influential in that manner. And, certain bit of tariff barriers which put on inflationary pressure lead to economic fallouts. And you lead to a globalized, fragmented world. How do you trade in this kind of a scenario of a globalization? If there were freer trade policies and weaker alliances, this is where we were till date. You were in a globalization light area. For those sectors which are not very strategic to you, you would want to move to a friends first area. If you are friends with a particular, you've got an ally, you're happy to trade those which are not strategic in your and strategic for your own reasons. You could trade within yourself, but for your strategic sectors, you have to have a protectionism out there. And this eventually, if it were to lead to a Cold War, you would then have very nationalist economic policies and then very strong allies as such. We're not there yet. We're in a new kind of a Cold War, call it a Cold War light kind of area. Countries out there are trying to become self-reliant. The countries out there are trying to find new friends. We'll figure out. These are the sectors that we listed out in our annual playbook, the one that I showed you before. This is in January 2025 that we came out with this playbook. These are the sectors that we liked. We liked the fertilizers, CDMOs, and API space. We think we've been good there. Metals and mining is something that we liked. We've been able to get good places there. Oil drillers, again, is something that we liked. Again, we had no idea there would be a war in the Middle East. It just happened to be that we thought that, certain kind of the geopolitical areas that we were kind of looking at, we thought we would move to a nationalist policy kind of thing, and hence thought that drillers would make a lot of sense. Similarly, chemicals also make a lot of sense. So this is where we are. These are the remaining sectors that we felt which were good for the year. I think the only kind of different that we feel right now is this technical textile one. That's because of the tariff. We're not expecting this larger tariff, but here also we've got the tailwind of two large competitors kind of uh, yeah, and diplomatically strained as such. So we still holding on to it. We figure out as and when things move on. Another question that we got was on inflation. That should I buy gold because inflation, or if you're saying that inflation is gonna go up, should we buy gold? We've looked at gold, the relationship between inflation and gold in a very different lens rather than the traditionally thought about. We feel the traditional way of looking at if inflation were to come up and then we would buy, or if inflation were to go up and we should buy gold, is somewhat a broken relationship. Why? Because when we ran this data since 1973 to now, which is quite solid 60 years of data, we saw that if when you correlate inflation and gold, the correlation between them is 0.29. So 0.29 is not quite a large correlation to be very happy about, and that is why we thought that this is not the right take to do. So what we did was we flipped the lens. We said that does a rise in gold prices drive inflation? And this is what we did was we kind of took the gold returns and then lagged inflation by a year and 2 years. So 3-year average correlation then lifted itself up to 0.68. So what we believe, and when we look at inflation and gold, we look at a run up in gold prices as something that drives inflation rather than the other way around. So that's there. And what we feel is that gold may predict inflation better than kind of it hedges it. The other question was on bullion. So this is something that we came out in November 2024, a mean reversion strategy. When you look at so the question on bullion was whether silver looks better than gold or gold looks better than silver, what one should take on. We've got this answer for you, that when you look at gold and oil, we feel that the current, like, this is kind of a mean reversion strategy. These are ratios that kind of come back. Like there's no guarantee that they should come back to the mean, but when you run a mean reversion strategy, you expect things to fall back into shape over a certain period of time, and that's what the mean reversion strategy works on. A lot of people use this, have been quite profitable. A lot of people, Nobel laureates, have burned their hand using this strategy. But we came out with this mean reversion strategy to figure out if there was a valuation gap out there. So when we ran this ratio, gold and oil currently sits at a ratio of 45 times. 45 times as expensive as oil is gold right now. So gold is 45 times as expensive to oil. When you look at the median average that it is, gold should be around 17.5 times as expensive as oil. When you run this with gold and silver, the current ratio comes out to be 90 times. Gold is 90 times as expensive as silver. The median for this has been 71 times. Now you run Nasdaq versus gold. So Nasdaq is supposed to be around 4 times as expensive as gold. Currently, it trades around 6.5 times as expensive as gold. So when you look at these valuation gaps, the attractiveness comes out to be that we feel that, at least in terms of valuations, oil is much cheaper than silver or gold, and which is then cheaper than Nasdaq. Another question that we kind of got was that is it possible to predict market moves? The whole one was the interesting one. Short answer as to the time frame that you're looking on. If you were to ask me, can I predict what will happen to the market in the next 5 minutes? I don't have that skill set, to be very honest. People out there claim to have that skill set. I really don't know how to do that. But because we're talking so much about valuations, what we look out is for signals. So this is a particular signal that we look out. This is the valuation signal. This is when S&P's forward PE goes above 21, and so here the diamond shaped things are basically the 10-year returns that happen, right? When based on today's forward PE number. So once your PE goes up 21, once you become more expensive than 21 times, the returns kind of start becoming negative. Very, very like they just start disappointing over the next 10-year period. Today we are at around 23.8 times earnings, forward earnings, and this suggests us that possibly there is a possible chance that at least in the next 10 years, the long-term equity returns may be muted. It is a good time to taper down equity returns expectation. And what we are saying is that it does not mean that tomorrow morning you go out and sell everything. No, you've got to be disciplined and do not have to have blind optimism out there. Once you come back to good territory of valuations below 20, the odds tilt back into the favors of equity. So again, valuations as a signal won't tell you when. We don't know. This market can continue to be rational. We could have this next meeting and say that the current forward P right now at 26 times. It could be very much possible, right? Either returns expectations have to taper down or earnings have to catch up very fast. Either one of them has to happen. We just don't know when, but at least they're warning us to what could come around. The next question that we got was basically, I'm a beginner and where do I start? This is an interesting one. You could something that we are looking forward for. You could start with following us on social media accounts, Instagram and Facebook and YouTube. We're also introducing Investing 101 session for financial freedom, those who are interested in financial freedom, young folks who are interested in financial freedom, starting this Independence Day. We've been bringing out this particular Investing 101. This will be a monthly session. We'll take on one topic at a time, starting with a certain topic and then moving on and building onto it, and how to basically create a portfolio for yourself. The last question I think which we got was basically, again, this is the question that comes up every time. What kind of returns have been we able to generate? Again, we've always told you that there are different market cycles. We don't guarantee returns out there, but this is how we've been able to perform the green shaded area. The last time that we showed you an average performance, people said average can be misleading. So this time around, we've given you the entire range of it. So the green shaded areas are live model portfolio that we've run over the last 28 months that we've been in existence. And this has been the return. Because our strategies are multi-assets, we believe in precious metals, we believe in debt, we believe in equity, we believe in holding cash at a certain point of time. We've compared this with Nifty and gold. The blue line is Nifty, the orange line is gold, and the green area is basically the returns of our portfolios. I think with that, the presentation, I think I'm done with, but I'll just open up the floor for any questions that people have.
Yeah, I have one question.
Yeah, Nitish, go on.
Yeah, so given that the geopolitical tensions are rising globally, what is your opinion? Do you still see value in diversifying into developed economies like the US, or do you think now it's a stronger case for concentrating more on domestic, like India-based markets?
Okay, so thank you for that question, Nitish. So whenever the world becomes volatile, diversification becomes a necessity rather than a strategy. So diversifying is good. However, given that over the last 2 decades, we've not seen kind of decent returns from emerging markets, and with the problems that are popping up in the developed market, we would, if there was an asset allocation where we were to choose between developed and emerging market, we would end up being a little bit of tilted towards the emerging market rather than being in developed market. That's where we think valuations make a lot of sense at this point of time, rather than chasing quite expensive markets.
Got it. Thank you.
Hi, Karan. We have a question in the chat also, if you could answer that.
Sorry, go ahead. Yeah.
We have a question in the chat, in the meeting chat box.
The view for the next 1 to 2 months. Mm, this is a good one, Amnat. Thank you so much for the question. So where are we today? We've been hit by tariffs at this point of time. Valuation wise, we are okay. We're not that expensive. We are slightly expensive. We're not that expensive. However, there are certain overhangs that are there with Russia given a 10-day period to end or reach a ceasefire. We being dependent on Russian oil, it's quite a volatile way. We go with what we are giving as an asset allocation. It would be good to hold on to some bit of cash at this point of time. And opportunities again, again certain things like yesterday itself, you had Trump tell you that there is no tariff on copper when like 10 days back he said that there is a 50% tariff on copper, and then copper went down like around about 5-6% in a day. You have those kind of opportunities available as such. So being nimble around dry powder is how we would want to play this. We'll be happy holding a neutral weight to India at this point of time, having around 40 to 50%, the range that we showed you in the asset allocation table. That's how one should have it in their portfolios. Cool. I think if no one's got any question, we'll thank you all for joining. It was pleasure hosting you. And as we move forward in this volatile world, it makes a lot of sense to keep some powder dry and be as nimble as possible. That is how we are doing it here. Again, if you're interested in creating a gold-based portfolio, then logging in onto llamaresearch.in would be a good way to start. Thank you again, and have a good evening.
Thank you.
Thank you.
Thank you so much, Karan, for the amazing session.
Thank you, Nath. Thank you so much for attending.
Thank you,
Karan.
Thank you.
Thank you so much, sir.
Thank you, Manju.